We all use checking and savings accounts, right? But how many of us actually understand the invisible machinery operating just right beneath the surface? Today, in this explainer, we're literally pulling back the curtain on a pretty massive question. Why do banks really want your money? Let's dive in.
It's a fascinating question when you stop to think about it. Have you ever wondered why banks are just so happy to hold on to your cash? Sometimes they even go out of their way to offer you sign-up bonuses, even if they're paying you barely any interest in return. You know, we tend to think of our bank as this giant static vault, kind of like Scrooge McDuck's money bin. You hand the teller your cash, they lock it away, and it just sits there gathering dust until you need to buy groceries or pay rent. But actually, scratch that. The reality's entirely different. The money sitting in your bank account doesn't just sit there. It becomes a breathing, active part of a much bigger financial system.
So, Section 1, how your deposits actually work and understanding this whole banking ecosystem.
To really get why banks want your cash, we have to look at what actually happens the literal second you make a deposit. And there's a huge misconception we need to clear up right off the bat. A bank doesn't just take your specific $100 bill and immediately hand that exact same bill to the next guy who walks in asking for a car loan. It's not a direct one-to-one swap like that. Instead, your funds enter the bank's broader asset pool. Think of it like a massive reservoir of capital. The bank takes this giant pool and utilizes it for their broader business operations. And because they have this huge, stable reservoir of deposits from thousands and thousands of customers, the bank can confidently do business. So in exchange for you providing the water for their reservoir, they pay you interest, all while earning their own revenue.
Which brings us to Section 2, how banks make money, or what we call the revenue engine.
So if the bank is paying you interest, how on earth are they generating enough cash from that giant pool to actually make a profit? Well, their absolutely biggest driver is the interest they earn on loans. We're talking mortgages, auto loans, business loans, plus yields on other financial assets they hold. But it doesn't stop there. Banks also rake in a significant amount of money from fees and services. Think about your monthly maintenance fees, overdraft fees, or those wire transfer charges. Then you got credit card-related revenue, everything from merchant processing fees to the interest charged on revolving balances. Add in other activities like wealth management or treasury services, and you start to see the whole shebang. Your deposit, it's basically the foundational fuel that powers this entire diverse revenue engine.
All right, let's jump to Section 3, the truth about interest, using a quick fictional setup.
Let's try to make this abstract concept a bit more concrete and see how this plays out in actual dollars and cents. Imagine an everyday American customer. Let's just call her Sarah. Sarah goes ahead and deposits $10,000 into her savings account. Now, keeping in mind, this is strictly an illustrative example just to show you the mechanics. It's not representing any specific bank's exact profit margins. But Sarah puts her 10 grand in, expecting it to be completely safe and, maybe earn a little bit of yield over the course of a year. So what happens next?
Over that year, Sarah earns a small sliver of interest. That's essentially her reward for keeping her money in their system. But the bank? They generate a much larger slice of revenue by leveraging her deposit along with millions of others across their broader balance sheet. By pooling her $10,000 to back higher-yielding loans and investments, the bank earns a significantly larger return. So, you got to ask yourself, who's really making the most from that money sitting there? The spread, the difference between what the bank earns on its assets and what it pays out to depositors like Sarah, is known as the net interest margin. And that margin is exactly why banks are so incredibly eager to welcome your deposits.
So as a customer, how do you actually measure that little slice of interest you're getting? Well, you absolutely have to look at the APY. That stands for annual percentage yield. This is a critical term to know. It's the real rate of return earned on an account, specifically because it takes into account the magic of compounding interest. Compounding interest is basically you earning interest on your interest over the course of a year. If you want to know exactly how hard your money is working for you at any given institution, the APY is literally the only number that gives you the complete, accurate picture.
Which naturally leads to a very common question. Why do some accounts pay almost nothing while others pay significantly more? Think about traditional savings accounts, the ones you often find at large brick-and-mortar banks. They have massive overhead costs, buildings, tellers, ATMs, the whole 9 yards, so they typically offer a much lower APY. Contrast that with high-yield savings accounts, which are frequently offered by online-only banks. With zero physical branches to maintain, their overhead is dramatically lower, and that allows them to pass those savings right back to the customer in the form of a higher APY.
You always have to look past the generic label savings account and check that actual APY.
Now for Section 4, safe versus growing money and why we use different tools for different goals.
This brings us to a bit of a hidden lesson that often trips people up when they're managing their personal finances. You see, a savings account, even a really good high-yield one, is primarily a tool for keeping money safe. That's where you put your emergency fund. It's where you stash cash for, say, a down payment on a car you're buying next year. The whole goal here is preservation and liquidity. You need to know that if your roof suddenly leaks tomorrow, your $5,000 is sitting right there, ready to be used. On the flip side, making money grow is the domain of long-term investing. That involves entirely different vehicles with different risk profiles. Now, I'm not here to give you personalized financial advice, but educationally speaking, it's absolutely vital to understand that a bank deposit is designed for stability. It's not a tool for generating massive wealth over decades.
Moving on to Section 5, what you should know to navigate your options.
Armed with this understanding of how the banking ecosystem works, what are the practical things you actually need to pay attention to? When evaluating an account, here's your quick checklist. First, obviously the APY. We want our slice of the pie to be as optimal as possible. But listen, an APY means absolutely nothing if it's eaten up by our second point, monthly fees. Always check for hidden maintenance costs. Third up, minimum balance requirements. Are you going to be penalized if your account drops below a certain threshold? Fourth is the accessibility of your money. Can you easily transfer funds? Are they hitting you with strict withdrawal limits? And finally, alignment with your financial goals. Does this specific account serve the purpose you need it to serve right now?
Oh, and there is one more non-negotiable factor: FDIC insurance. This is the absolute bedrock of trust in the American banking system. It stands for the Federal Deposit Insurance Corporation. And what it means is that your deposits have federal protection up to applicable limits. Right now, that's $250,000 per depositor per insured bank for each account ownership category. This ensures that even in the incredibly rare event that a bank actually fails, your safe money remains completely safe. The government backs it up. Always for sure verify that any institution holding your deposits is FDIC insured.
As we wrap up this explainer, I really want to leave you with this core thought. Your bank account isn't just a place where your money sits. It's part of a financial system designed to move, lend, and earn money. By understanding your role in that system as a depositor, you can make way smarter, more informed choices about where you place your capital. It's all about ensuring that the arrangement works just as well for you as it does for the bank.
So the very next time you pull up your bank app and look at your balance, ask yourself, is your money just resting in a vault somewhere, or is it working as hard for you as it is for your bank? If you found this explainer helpful and want to continue unraveling the mysteries of everyday finance, make sure to hit subscribe to Honorog Global. We're totally dedicated to providing simple, clear explanations of exactly how money works in America. Keep learning, keep asking questions, and I'll see you in the next explainer.